Good morning everyone, this is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 5th of August. Bank of England unveils stimulus package, more easing to follow. On its first Super Thursday following the EU membership referendum, the Bank of England delivered a package of easing measures over and above market expectations. The Monetary Policy Committee lowered the bank rate by 25 basis points to 0.25%, as was expected, but also expanded the size of its asset purchase program by £70 billion, something that was not anticipated by investors. Perhaps most importantly, the Monetary Policy Committee provided clear forward guidance on the rate path by indicating that if incoming data are broadly in line with the inflation report forecasts, then most members expect another rate cut by the end of the year. The British pound plunged immediately on the news and continued lower while Governor Carney was presenting the inflation report at the press conference after the decision. Considering the bank's aggressive package of measures and its signals for additional easing further down the road, we maintain the view that the near-term outlook for the pound remains negative. On a longer-term perspective, we believe that slowing investment inflows to the UK in coming months could cause the nation's current account deficit to widen further, which may add even more pressure on sterling. Today, the highlight will be the US employment report for July. The forecast is for non-farm payrolls to have risen by 180k, considerably less than June's astonishing surge of 287k, but still a strong reading that would point to further tightening of the labour market. Even though the ADP employment change was nowhere close to the NFP number the last couple of months, it's still the most closely watched gauge of non-farm payrolls. The ADP print hit 179k in July, something that supports a solid NFP figure. The unemployment rate is expected to have declined to 4.8% from 4.9%, while average hourly earnings are forecast to have accelerated on a monthly basis, something that would keep the yearly rate unchanged. Following the first estimate of the second quarter's GDP, which showed that growth was much weaker than anticipated, we believe that this employment data will be critical for market expectations regarding a potential near-term hike. The forecasts suggest another month of strong employment gains overall, something that could revive optimism over the health of the US economy and thereby reverse some of the dollar's recent losses. As for the rest of today's indicators, during the European day, Germany's factory orders for June are coming out and the forecast is for a rise following a stagnant print last month. From Canada, we also get the employment data for July. Expectations are for the unemployment rate to have risen, while the net change in employment is expected to have turned positive. This suggests to us that the increase in the unemployment rate may be due to a rebound in the labour force participation rate, which declined last month. That would still point to a solid report, something that could support the loonie on the news. We also get trade balance data from both the US and Canada at the same time as their respective employment reports. We have no speakers scheduled on today's agenda. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.